Good morning, everyone. On behalf of Brickwork Ratings, I'm delighted to welcome you all to today's webinar on microfinance industry in India, balancing growth and risk. My name is Vikrant Chaturvedi, Associate Director Research at Brickwork Ratings, and I'll be your moderator for the session. We are privileged to have with us two distinguished experts, Mr. K.H. Patnaik, Chief Rating Officer at Brickwork Ratings, and Mr. Hemant Sagare, Director Ratings at Brickwork. Both our speakers bring decades of experience in credit ratings and deep insights into the BFSI and microfinance sectors. Before we dive into our discussion, let me briefly introduce Brickwork Ratings. We are one of India's leading credit rating agencies accredited by the RBI and recognized by SEBI. We provide independent and credible credit ratings, research, and risk assessment services across a wide spectrum of industries, including banking, financial service, infrastructure, and corporate sectors. Let's begin by setting the stage. The microfinance industry in India has played a transformative role in financial inclusion, reaching millions of unbanked and underbanked individuals, especially women and rural entrepreneurs. Over the past decade, the sector has witnessed remarkable growth driven by innovative lending models, supportive regulations, and the relentless commitment of MFIs to serve the underserved. However, this growth story is not without its challenges. The sector faces evolving risks ranging from credit and operational risk to regulatory changes and external shocks such as economic downturns and natural calamities. Striking the right balance between sustainable growth and prudent risk management is crucial for the long term stability and impact of the MFI sector. In today's session, we will deep dive into the current landscape and growth trajectory of the microfinance industry, key risk factors and mitigation strategies, and the evolving credit rating environment. Our speakers will share their perspective, followed by an interactive Q&A session where we welcome your questions. Once again, thank you for joining us, and we look forward to an engaging and enlightening session. Now, for the presentation, I would like to invite Patnaik sir, who will share his insights in the industry.
Yeah, start the presentation. Uh, I welcome you for this webinar on microfinance industry. Thank you, Mr. Vikrant, for a brief introduction to the webinar of today. Let me take through a brief outline of the industry. This microfinance industry evolved over a period of time over decades. Before existence of MFI, there were self-help groups which were formed in the rural and semi-urban areas by 15 to 20 women of homogeneous nature. They used to form a group and collect monthly savings and maybe 100 rupees, 50 rupees per person, and open a bank account and deposit every month regularly the saved amount in the bank. Over a period of 6 months to 1 year, when their corpus grows up, they used to approach the bank for a loan. Bank used to give in multiples of the savings made by the group, maybe in terms of 2 times, 3 times, 5 times, etc., depending on the maturity of the group. Initially, these groups used to take the loan and distribute among the members equally, and they used to use this money for a consumption purpose. And every month they used to, apart from savings, they used to collect the EMI for the loan and deposit in the bank. This has been going very smoothly, and banks were also encouraging to give the loans to the self-help groups, because these are all again state government set up. Some of the states through the gram panchayats and mandal headquarters used to regulate these loans, and accordingly the repayment culture was good. The repayment is close to 100%. When the group matures, they used to take a higher amount of loan to set up a small scale industry, which all the women group members can contribute and do the activity, and used to sell in the market and get revenue and repay the loans. This has been a success story, especially in the states of Andhra Pradesh, Telangana, Karnataka, Kerala, and Tamil Nadu, and some of the northern part of the states as well. So this success story has evolved over a period of time, and joint liability groups also formed. In JLGs also, they used to take loans from the bank and for a productive activity. Though there has been going smooth and repayment culture was very good, repayment capacity was good, the expected growth was not happening. The integration is not happening across pan India. So a necessity was felt that institutions back institutions should come forward to lend to reach out to many people. This is the origin of the formation of microfinance institutions through the NBFC. NBFC registered the Reserve Bank of India and started a vertical of microfinancial institutions. They, so that the intensity can go up and the reach will go up and they can reach out to the many number of people instead of few segments of the people. This is how the origination of MFI has started. Next slide. Yeah, just you see over a period of time, yes, the credit has grown and the amount of outstanding with the uh, has gone up. The problems started coming up. How the problems have started in the microfinance industry? Just to have an understanding about this, just look at the area. Borrowers, predominantly women in rural and semi-urban communities, are juggling multiple or more loans simultaneously from the MFIs, self-help groups, traditional money lenders, and digital lending apps. Despite coming of MFIs into picture, the groups used to take loan from multiple institutions, thereby the debt burden has gone up. The initial, the, if you start with the problem, the loan, initial borrowing, first loan taken for legitimate business purposes or for a family need. If it is legitimate business purposes, they will raise the money and they use for the business activity and they earn out of the business activity and repay the loan. Wherever they used to take this money for family consumption, they used to repay in a as per the income generated from them from the family sources and used to repay the loans to the bank. However, if it is purely for consumption, if they don't have any other alternative sources of repayment, then repayment struggle starts and default starts. See, the second stage is repayment struggles, difficulty in repayment that leads to seeking additional loans. The moment pressure mounts up on repayment of the loans, they look at for alternative sources to take one more loan. Then again, they take either approach the same MFI or a different MFI or a bank. They will take another loan to repay the loan. This problem gets multiplied once default starts. Then a situation will come. They keep taking the loans, more loans to repay the existing loans, and the borrower enters a vicious circle whereby it is very difficult for them to come out, and over a period of time in a span of 1 or 2 years the debt burden goes up substantially, which goes beyond the repayment capacity of the borrower. Next slide. Yeah, what are the key challenges in the microfinance industry? The first and foremost challenge is over indebtedness and loan defaults. Yeah, just I explained, because there is a pressure for repayment of the earlier loans, borrowers started taking loans from multiple institutions. Yes, there is a rural semi-urban India is very large and many microfinance institutions came into existence, and with the competition for disbursements, they started most major institutions, multiple institutions approaching the same borrower to take the loan, and the borrowers also tempted to take the loan to meet their repayment pressures as well as the family commitments, due to which the debt burden has gone up substantially and loan defaults started. To avoid the loan defaults, the MFAs themselves encouraged to give more loans to them to sell earlier loans to see that delinquency rate in the MFI is low. Then competition from digital lenders. As all of you know, because of the technology upgradation, lot of digital lending, end-to-end digital lending practices have come. There are many fintech companies which came into the existence, which have given the software to all these MFIs or platforms to do digital lending online. The only problem is lack of proper business rule engine. Though digital lending practices are good, it will reduce the time, it reduce the cost, it reduce the operation cost, efficient. But the problem is, if business rule engine is not properly done, there can be a probability that a defaulter can also be made eligible to a loan. This is competition from the digital lenders has a heat up in the market, and people started giving more loans. Then Credit risk and delinquencies. Yes, as I explained, any borrower can have a particular capacity to repay, particular capacity how much loan he can take. The moment he takes loan beyond his means, then credit risk automatically intensifies. That gets converted into delinquency. That credit risk and delinquencies have gone up in the industry over a period of time. Then financial illiteracy. This is one major challenge MFIs are facing today because most of the 80 to 90% of the loan book of MFIs are focused in rural and semi-urban centers. Even today, illiteracy is still high in rural areas, whereby the borrower may not be knowing the implications of not making the payment on time, because of which they enter into a debt trap. So the MFIs have not taken much steps to or educate the people the need for a prompt repayment, need for using the money for the purpose for which it has been raised. All these things need education, a lot of literacy camps, literacy education to be conducted at the areas to overcome this kind of a challenge. Then high interest rates and operational cost. All of you are aware, this is one area Reserve Bank of India has come out with the guidelines recently, which we will discuss in the later part of our slides. The most of the MFIs we charge very high interest rates. See, actually, when the self-help group started borrowing from the banks used to charge around 8 to 9% linked to their RL repo linked lending rate. So the rate of interest was not very substantial for the group's members to pay the loan. Whereas these microfinance institutions cannot have access to so much of capital or 0% cost of funds. They themselves raise money from the banks at a rate of 8 to 9%. Naturally, they used to lend at 18 to 20% interest to the borrowers. Because of the high interest burden, and also the MFIs has to cater to the huge number of customers and number of pockets, the operational cost is also very high. So due to which the industry is started facing the problems because of high interest burdens. Then regional disparities. Yes, all in the entire country, each region having a different kind of approach. Some of the regions where there is a continuous productivity activity will be there, where these loans are used for productive purposes, the repayment climate will be good, everything will be fine. Some of the states like Karnataka and Tamil Nadu today facing a different kind of a problem, whereby the repayments are slow and whereby the repayments are not forthcoming, delinquencies are going up in these two states. It's all because of the regional disparities also impacting the industry. Then limited access to capital. As I said, there are many MFIs came into picture. There are very small MFIs with a loan book size of 50 to 75 crores or less than 100 crores, I can say, and with a bigger MFIs like bigger players, maybe having 14 to 15,000 or 20,000 crores of loan book. And in the meantime, there are many small finance banks came into picture. They also started targeting the microfinance groups and started lending the money to the rural folk. So these are all those people who are having access to the capital. They used to penetrate the market. The MFIs who don't have access to capital could not penetrate, and they are facing the challenges of liquidity and a weak governance and limited transparency. This is another challenge of MFIs. Governance and the transparency is a key challenge, and most of these institutions not able to maintain the transparency and governance in the required standard due to the cost, due to the various other factors. These are some of the challenges being faced by the industry. And regulatory challenges and policy uncertainty. This regulatory landscape of the MFI and the policy uncertainties I will discuss in the latter part of these slides. Next slide. Yeah. Now I request Mr. Hemant Sagare, Director of Ratings, to just develop on the few more slides.
Thank you, Mr. Patnaik. Thank you, Patnaik, sir, for that insight on our sector as of now. I would like to touch upon the data as of March 2024, how the microfinance industry has grown to the levels. We see the growth majorly happening during FY21 to FY24 period. So the data as of FY24 shows we have active live borrowers of around 715,000 live borrowers. with the active loans of around 1,23,879. We see from this file is basically the microfinance is spread across banks, SFBs, that is a small finance banks, NBFC MFIs, NBFCs, and not-for-profit MFIs, with major chunk being at NBFC MFIs. Across these parameters of active live borrowers, loans, portfolio, disbursals, average ticket size, 30 plus delinquency, and 90 plus. I'd like to touch each one of this. We see the active live borrowers, they are 85,715,000. Earlier stated, active loans at 123. Portfolio is at around 3.77 lakh crores. Disbursed amount is also increased at 1 lakh 4. This disbursal is basically on the last quarter basis, where we generally see the spike happening in the last quarter, that is the Q4 of FY24, and it has been traditionally been there over the previous 3 years. The average ticket size for these kind of loans, the microfinance loans, have been below 50,000 rupees per borrower. And we see the delinquencies in the sense of the slippages more than 30 days have been lower than 3%, or even to the extent of 2.5%, except for in case of not-for-profit MFI. 90 plus delinquencies, yes, they were lower also further, less than 1.5% across, except for the not-for-profit MFIs. So here what we try to understand is the parameters across the MFIs, as had stated, where it was very slow growth at one time, had grown to a substantial levels till March 2024. We have seen the changes happening during this year. As we move on to the next slide, where we have tried to capture upon the 9-month data, or as of 31st December 24. Now, in this slide, we see we can make a comparison as of what March 24 to March December 24 has moved. We see the active live borrowers, which were around 85,000, have moved to 87,000. The active loans, which were around 1,23,000, now crunching to 1,19,000. There's a 4,000 dip there. We also see the portfolio basically crunching from 3.77 lakh crores to 3.48 lakh crores. Disbursals, yes, comparable, not much comparable, because this is the Q3 numbers, 63,959, but still it seems to be on the lower side as compared to what Q4 FY24 was. The average ticket size here, we see the spike going above 50,000 per borrower. I'll touch upon the average ticket size later. Would like to touch upon first the 30 plus delinquencies. Here we see the delinquencies which were less than 3% at one point at March 24 has gone up or spiked up to 7% levels. The reasons being, we can see that the collections of these entities or these borrowers have come down from Q1 onwards, Q1 FY25 onwards to Q2 and Q3. These are the mounting. Why the collections have been increasing is basically when we see the growth pattern of these loans between 21 and 24. To understand is that these loans are basically to the tenor of 18 months to 3 years. Now, the spike basically happened from 22 onwards. There was a growth visible, and the 24 month at March 24 is where we see the 18 months getting completed. This is where the major repayments were started. Now, these collections have slowed down during this year in the 30 plus delinquency from Q1. Q1 were relatively expected. Normally, Q1 is always a slower growth. But Q2 was where the stress was visible, as well as the Q3. This is where we see the 7% and may likely to be remain on that similar levels on the going forward. Though some reports in the market state that this will further go, this will improve and so and so, but on a delinquency level basis, till the stabilization happens and the disbursal of loans. Now, this ticket size, which I said about 50,000 above, are the borrowers, not the unstable borrowers, that the delinquent borrowers, but they are giving higher ticket size to a stable borrower who has shown a better track record of repayments and becomes eligible for the higher ticket size. This way, the microfinance industry, which is facing a crunch in the industry, is trying to grow its book by having a more stable account in their portfolio. The 90 plus DPD already, that is delinquencies, already crossing around 4% in NBFC MFIs and across the industry around 3%. This is where we see the crunch happening, and maybe this is what the points will be to look forward in the scenario of the regulatory changes happening. We seen the guidelines had come in from November 22 onwards. MFIs were asked to have a higher risk weighted because these are unsecured loans. They were considered to be in line with the consumer loans, and they were expected to have a 125% risk weighted portfolio. However, going forward to improve upon, the regulator had come down to bring it down to this. I would hand it over to Mr. Patnaik to talk about the same on the next slide. Patnaik, sir.
Yeah. See, what are the new regulatory changes that has introduced Reserve Bank of India to strengthen the microfinance sector? As all of you are aware, when the portfolio size has gone up substantially, RBI found certain risk is sinking in the industry. RBI taken certain challenges, certain measures to see that the loan book is stable. See, they started with the NBFCs, increase the risk weights for all the category, AAA, AA, rated category borrowers. And also they started increasing the risk weights for unsecured loans to 125%. Simultaneously, for microfinance, they said the risk weights are to increase to 125%. The moment risk weights are increased, automatically the banks will increase the rate of interest for lending to the MFIs. Thereby, ultimate lending rate goes up. Looking at the industry problem, looking at this situation, RBI again came out immediately, and in the month of February 2025, they reduced the risk weight from 125% to 100%, so that the ultimate lending rate to the borrower will be capped at a particular level, because RBI would like to see that there will be a transparency in respect of rate of interest being charged to the customers. So one of the first measure taken by Reserve Bank of India in the month of February 25 is to reduce the risk weights. Number two, revised lending norms. Yes, from November 2024, RBI start any new lending norms have been introduced to the borrowers, and borrowers with having certain delinquency, they put some restrictions on the loans, and accordingly RBI brought out new set of guidelines with regard to lending by the MFIs to the borrowers, which I dealt with in the later part. Then regarding interest rate transparency and responsibilities, RBI has directed all the MFIs to declare what is the lowest rate of interest they will charge, what is the highest rate of interest they will charge, what is the penal interest they will charge for the delayed repayments, and they have to display in their website as well as in the pamphlets being circulated and the advertisements they release it. They need to transparently disclose the rates being charged to the ultimate borrowers. That has resulted in somewhat streamlining of the rate of interest being charged by MFIs to the ultimate lenders. Then loan amount cap. Yes, now they brought in a scheme that what is the maximum amount of loan that can be given to a borrower. They brought restrictions, and up in the whatever collateral free loan given to the households with an annual income up to 3 lakhs, they have frozen at 2 lakhs per borrower. So because earlier there were no such restriction, most of the MFIs used to approach the same borrower and used to lend the money, so that the borrower used to tend to take more money. Now RBI put certain restrictions on the borrowers to raise the money from MFIs. Next slide. Yeah, this is the all of you are aware, the primary regulator, of course, being the Reserve Bank of India as a licensee for NBFC MFI license. Apart from that, there is a self-regulatory authorities have come into picture as per Reserve Bank of India notification. Many institutions can have their own self-regulatory entities. MFIN is one of the self-regulatory entities which can control the and all MFIs. Most of the MFIs follows MFIN, that is Microfinance Industry Network, and certain new set of guidelines which will be very effective from couple of days from today, tomorrow, day after tomorrow. One is maximum lenders. Earlier, each borrower used to approach 3, 4, 5 institutions, take loans. One loan from one particular institution and repay to other loan. It's like a cycle they are going on. Now the restriction will be on 3 lenders maximum. So this can be controlled by seeing the CRIF report by MFI and ensure that the borrower has not taken borrowed money from more than 3 lenders. Top up loan. This is one area. If you see the loan disbursals, it is close to 1 trillion in 1 year space. Whereas the loan book has not grown by 1 trillion, because most of the loans are to refinance the earlier loan or to repay the earlier loan with a small top up. So the top up loans were, there are no earlier specific rule by when we have to give top up loan, how much you have to give. Now RBI brought out this MFIN has brought out guidelines saying that top up loans only after 50% of the repayment of the earlier loan or 12 months might have been completed from the date of the loan, because most of these loans are given for 24 months to 36 months. Most of, because these are unsecured in nature, all MFIs give loan for a period spanning to 24 months to 36 months. So at least minimum 1 year loan should run, then only they will be eligible for a top up loan. And indebtedness cap at 2 lakhs. Yes, yeah, discussed. Now the total outstanding against any borrower from all the institutions is not more than 2 lakhs. And also there is strict guidelines were brought with regard to delinquency. If there is a delinquency of more than 60 days of over 3,000 rupees, they are not eligible for fresh loan. No MFI can lend loan for such type of borrowers. So these are the self-regulated entities instructions, if followed, probably bring some kind of discipline in the market microfinance industry. Yeah, next over to Mr. Hemant for the next presentation.
Thank you, sir. Thank you. As Mr. Patnaik sir said about the delinquencies increasing and the measures being arrested, I'll take a step back and talk about how the models have evolved from traditional GLG models to emerging urban realities and the digital transformation. As has been earlier stated, the basic prima facie for having these kind of models were to have a community-based lending and which come together for a common goal or generate a common interest for income generation. That is where the SNGs and JLGs came. Initially in India around 70s, which earlier prior to that we had money lenders who were very well into the segment, but a formalized structure came in with the Seva coming in from the 70s. That is for in Gujarat, where the Seva Bank was formed, that is the Self-Employed Women's Association was formed during that period. Its primary objective was to empower the women by providing them access to financial services, enable them to start their small businesses and improve their livelihoods. This is where basic initially started. Then it moved over to SHGs, where self-help groups were formed, and NABARD played a crucial role in it. NABARD, which was a formation again of RBI's ARDC, had a critical role to play. Now, uh, these SHGs and JLGs models, their basic requirement or basic structure was such that the orientation for the SHGs were all the savings oriented, as Patnaik earlier stated, and the borrowings were made from available from these deposits that were done. While JLGs were basically having a credit oriented formations to avail such kind of loans. The SHG models that they followed were based for banks basically, and have linkages with the NABARD. While in JLGs, these were mainly used by the MFIs. The group size in SHGs were around 10 to 20, while in JLGs were around 5 to 10. SHGs were more formal structures having a defined secretary, treasurer, and an interface. The SHGs were the interface to interact with the financial institutions, where in JLGs, the interface was directly the individual borrowers with these financial institutions. The SHG model growth was a slow growth, but the faster growth was seen from the JLG model. We see this basically the SHGs had a common purpose, like as I already stated, they have entered into a same activity and work together. The JLG members invested loan for different purposes. That is, they didn't have any common structure. This is where the dilution we see during the urban reality that happening. The people who are coming together for a common goal and a common program, that went into a more individualistic approach, and the focus was more on an individual rather than on a group's common arrangement. The group members itself initially, which were related people, or they came with a common idea, these were completely different strangers, like just to form a group, and there was a dilution. There was no commonality of the objective. So this kind of growth was tremendous happening in the urban reality. This data was so scattered and moved about that it led to a digital transformation. Now, digital transformation, where we see various credit bureau integrations happen. The role of CIBIL was very critical, They integrated all the information pertaining to this. These CIBIL scores helped in checking these kind of loans by the banks, especially. While the MFIs did not use this CIBIL score, they were for a loan given to JLGs because these were unsecured loans. They were only the collateral that was available was the guarantors of the group itself. So there was no direct security on this. So these data was required to be vendor. MFIN made it that to use Highmark and Equifax uh, as the aggregators to aggregate this check credit scores and provide. So MFIs and other financial institute have to submit this data to these kind of borrowers in a consolidated format to the Highmark and Equifax. And Highmark used are the Credit Information Bureau, which used to provide this data. Apart from the MFI, they would also collect the data for the MSME and the retail consumers and the microfinance borrowers. Now, this integration helped in having a data at a common place, and the access was also available to the microfinance lenders. This not only helped in reducing the manual verification processes, but also helped in reducing the heavy documentation. The paper-heavy documentation was more on a platform-based network, and which it also helped in reducing the insufficient data analytics. We can move on to the next slide, Vikrant. And here we will talk about the how this microfinance has a sustainability to strengthen the system. It's not fully sustainable currently, but it is the efforts are on to strengthen the systems. As the loan book also grows, there are a number of borrowers also require still financial inclusion not reaching to its mark. Efforts are on. While we see how these steps are taken up, the collaborative ecosystem, as we said, that collaborative data, the collections of data at one integrated place will help us in having a commonality or where the which kind of loans are better, what are the costs. Because these institutions like Equifax and Highmark, they give their CIBIL gives its score. The credit scores are available. The credit information reports are available, giving a background on the repayment track record of each of these borrowers. There is an important part of financial literacy. RBI saw to it that the loans were given by the microfinance institutions where the borrower was not aware of the other charges that were involved. He was worried only on the principal part, while there was an interest cost which was very high, and also on the other charges that were applicable to it. So RBI and the regulator made it compulsory for them to disclose these key facts statements to the borrowers so that they can also have access to what first is about the language in which they want to have this data that was to be standardized for the borrower to be accessed, annual percentage rates, that is the interest cost and the other charges that are required that have to be disclosed to the borrower. Equated periodic investments installments have to be specified to the borrower in their documents to the, and the chart was laid out to show what could be the what would be the repayment schedule and what intervals these will have to be paid. Now this helped in this kind of information collection, helped in improving their the financial literacy. So they were aware of whether the loans are taken, they have to be repaid in a certain systematic manner to avail for further loans. This will help them to grow their own businesses. Digitalization played a major role, as I've already discussed on that. Digitalization with the help of eKYC and eKYC, other verifications, all on a digital platform helps in faster loan processing, as well as recovery processes also become easier for the market to take it up. This is how the sustainable microfinance sector will grow. These are laid down structures. The key remains in how to follow these and how these are followed by each of the enterprise units at their internal levels. These are efforts made by the regulators also and the industry to improve on their system as we move forward. Can move to the next slide. It talks about how the microfinance book size has contracted during the last 1 year. As you see, the book which had active loans of around 10.7 lakh crores 7,000 crores. In December 19, the growth, which was steady growth up to March 22 or September 20, June 22, has started growth in December 23 onwards. We see 13.7 crores of active loans which we are seeing there. Also, the book was from which was around 218 went to 292 from December 19 to March 22 or September 22, and then the spike which there. This spike continued up to March 24, where we see 16.1 crores of borrowers. The growth. This is the average tenor that I was talking about. Is that the average tenor of these loans being 18 months? Now the cycle getting down, we see the decline. The collections have started initiated, and the collections is on the slower rate. This is resulting in not only visibility that the borrower is not able to repay. The growth is also a factor where these lenders or the borrowers were having access to multiple lenders at one point of time, and they get attuned to having this access of lend at all times, and they were repaying. So this is where the overburdening also started. Repayment collection, the collection issues thereby having in the last 9 months, which we see from 16.1 crore of business now going down to 14.6 as of December. The live customer base though has increased, so there is a huge potential of growth visible actually in the system, which can further grow. So potential is there very much visible, while the we need to have an active participation from the better product, better profile customers. And now gross loan portfolio, we see that 218,000 crores, which was at December 19, grew all the way up to 292,000 crores in September 20, June 22, had spiked to all the way up to more than 400. That's nearly 450 crores or 443 crores till March 24. And from March 24, we see the decline coming to less than 400 crores. We can move to the next slide. So to the loan disbursal value and volume slide, we can take it. Here, you see the disbursals as a result of collections. What is happening is disbursals also take a hit back. Collections is an effect that we see when we stated about the 30 plus delinquent increasing. That was the result where we see it's not only the collections which were declining, the disbursals also took us backseat, because obviously people wouldn't want to lend in a declining industry. This what has a double whammy effect in the sense that not only on the numerator goes, the decline in denominator is at a faster rate. So you see the AUM book crunching from 1,15,222 to all the way up to 63,440 is the disbursal amount which is coming down. So Q4 FY24, or if we say comparison to Q3 FY24, which was 97,400, has come down to 63,440 crores in Q3 FY25. We also speak about here is the average ticket size. Now that is where I came to was while efforts were to improve the growth in a declining disbursal rate, the better rated or the better quality portfolio clients were given higher tickets, and that's how the growth is visible from 48,000 to 48.6. This is what I'm talking about the last 4 quarters to 50.20 to 53.2 thousand crores. Can move to the next slide, Vikrant, please. This is how we see the shift in lending strategy. As I stated about book ticket size, which was less than 50,000, has now crossed above 50,000, and this is likely to remain as long as sustainability is concerned for the stress current that they're facing. As Mr. Patnaik has already explained about the stricter norms coming in the coming period from 1st June onwards, the 60-day bucket and 30 plus day bucket will become the norms going forward. While some of them, if are still following a 180 plus debit, where the 180 plus debit DPD or the PAR book is still continues to be high, 31 to 81 at 6.4%, and 30 plus data was already higher, crossing nearly to 7%. At 6.99% what exactly we had. We can move to the next slide, Vikrant. Now, given this scenario, why we talking about MFIs majorly or the NBFC MFIs is because they have the major share in the market. You can see this is a substantial portion they have been having in the industry over the last few years. And with the change in technology, major players, also bigger players and smaller players, equally have been contributing to this. The new age technology players like the fintech players like Paytm, PhonePe are supporting these kind of through digital loans. There are also other digital MFIs like Swatantra Microfin and others have contributing to this entity to improve growth, to extend growth at a faster rate, faster collections, and faster disposal of these loan processes. Next slide, please. Technology and digital transformation. These are the various lending platforms or the mobile platforms that they have. It enhances the client interaction. The clients are don't have to approach. Earlier in initial period, that was also the concern, wherein the borrowers, these are unsecured borrowers, they were not able to reach out to the bankers, and they had to reach out to these micro lenders or the money lenders. Now these are the MFIs which are now providing that accessibility through the digital phone or on your app based systems itself. So agent assisted models are available, fast which helps in faster processing and convenient transactions. There is a verification models being done through Aadhaar, UPI, and eKYC integrations. We have seen use of AI ML also picking up in the current speed to recheck the credit scoring of these borrowers so as to have a faster processing and reach out to the larger audience at the pace. We come down to the next slide, wherein we talk about the higher rating bucket. We have seen over the last 4 5 years, though as we said, that the stress is visible during these 9 months. We see sustainability or high rating buckets showing stability. There are a few reasons which we talk about in the A family rated entities are their financial flexibility as well as their strength in their capital. The stronger the capital, these people are able to sustain any kind of incremental losses. At one time, this kind of collections or these entities which had less than 1% NPA or the collections were all the way up to 99 has come down substantially to around about now we say 7.6, around 7% 30 plus DPD, and around 4% that goes around 95% of our collection efficiency. So this A family rated entities are able to have the capital support to absorb these losses in the coming period, while the lower segment with lesser access to the capital or lower financial flexibility are the ones which will show a weaker tendency in the coming period. I would like to hand over the next slide to Mr. Patnaik, where he'll cover up on
Yeah,
the outlook for this industry.
yeah. Most of the participants will be interested to know what is the outlook for the industry. I'm very clear. Let me spend some time on what is the outlook for the industry. Then we'll go for question and answer sessions. Already a couple of questions are coming, which we will answer first. Then you can give on the screen, comment screen, so that we can answer one by one. Let me look at the outlook. See, market potential and credit gap. All said and done, despite presence of so many microfinance institutions, banks, small finance banks, still there is a huge scope. If you see despite the growth, only 40% of MSME credit demand is met by formal channels, leaving a credit gap of 30 trillion, 30 lakh crores scope is there to grow. Means there is immense scope for the MFIs to grow their loan book in the near to medium term. The sector's total loan portfolio exceeds 5 lakh crores, but rural areas still rely on informal credit sources. Despite so much of increase in the industry level, the total loan book size today, as of today, we are talking about it is around 3.5 lakh crores microfinance book. Still, there is a rural population, the wide and all, and the concentration of loan book also in very few states like Bihar, Andhra, Tamil Nadu, Kerala. These are the states where the majorly focused. There is a huge scope for other states to other areas to grow. So that is one potential is there. Coming to the market potential and credit gap, the share of rural borrowers in the microfinance has reached a 10-year high. 83% of the clients are from rural areas. See, out of the total loan borrowers, 83% of the people are from rural segment, and there is some untapped segment of semi-urban areas where you can also extract where literacy percentage will be high slightly, and there will be likely delinquencies will be less. There is scope to grow in those areas. And MFI operates in 28 states, 5 union territories, and over 646 districts in India, reaching over 532 lakh clients with a total loan outstanding of 1.8 lakh crores under microcredit. However, 82 to 84% of the microfinance portfolio is concentrated in just 10 states, with 50% in Bihar, Tamil Nadu, Uttar Pradesh, West Bengal, and Karnataka. You see, out of total 100%, 56% of the loan book focused only in these 5 states. So there is a huge scope in other geographical areas to expand the activities, and also some kind of education, borrower education can be done by the microfinance institutions to encourage the borrowers to take money from the MFIs and also to start a gainful activity. And the microfinance sector is poised for growth driven by digitization, government support, and financial inclusion, but faces hurdles like fundraising, asset quality, and regional disparities. Yes, yeah, as I said, there is a huge scope, but there are other challenges, especially in microfinance. Barring few segment of the MFIs, others are not having access to raise the normal capital market segment to raise the funds, and also banks also looking at the present situation in the microfinance industry. Banks also started lending only to the high rated borrowers. So these small rated borrowers or less rated borrowers are having low capacity to bring capital, will have a lot of challenges in future to face it, especially in the light of the, I think most of you might have seen the March 25 quarterly results, yearly results of the small finance banks, where you could see the delinquency of the microfinance loan book. That shows that there is a stress in the industry, and there is a need to take steps to rectify the situation. So all, especially the small players in the industry, will have a lot of challenges to face in the industry. Sector shows the signs of recovery, better asset quality, and loan growth. So it is only expected that in the industry level, self-regulatory authority level, all MFIs can come to a small one platform and take a situation such a way that lending will be on the prudent credit risk measures and repayment capacity, not just to grow the loan book. Growing loan book is one side, other side, the moment you grow, automatically risk also sinks. So growth as well as risk will go together. It cannot be that I have a low risk and a high growth. It will not happen. At the same time, they should see the capacity to lend, and overall industry stability. We expect that because most of the problems are already set in, already came out, already disclosed, and there will be a slight, there will not be much in serious enough concern in future. We expect that the industry may stabilize over a period of next 1 to 2 years time. This is what the present outlook, what as a rating agency we're looking at, and rating downgrades do happen in the recent past in some of the clients because of the stress in the loan book and the portfolio at risk par data. However, we don't expect much more downgrades in the near to short term, as industry likely to stabilize. This is what from my side. Thank you. Now we'll take up question and answer session. Now I'll hand over to Mr. Vikrant.
Thank you, sir. Now we will take some of the questions that we received during the registration. So the first question: what are the post-sanction measures to be undertaken by a banker lending to MFIs? Sir, would you like to take this?
Yeah, I will take up this question. It's a good question from a banker's perspective. But remember one thing, banks, because cannot reach so many borrowers in a short period, they prefer to go for indirect lending by lending to NBFCs and MFIs. The ultimately post lending monitoring by the bank is very challenging, and ensuring end use of funds will be very challenging, because bank may give some 50 crores 100 crores loan to an MFI. That MFI will disperse this loan to thousands of people for different activities. So it is next to impossible for a banker to know how these individual loans are performing. So the only way how to look at it is choosing the borrower in the beginning. What is the strength of the borrower, how much capital he is having, how much capacity to bring capital at time of need, and what kind of procedures they are following for ultimate lending, like business rule engine, how they are following, whether the process being followed by NBFC or MFI to be seen by the banker first before lending to the particular MFI. Once money lent to the MFI, the entering spacing will be very difficult. Most of the loans still continues to be unsecured loans. So recovery depends on the cash flow. So my suggestion is, suppose if a banker giving a loan to a particular MFI, if it can be restricted to that the amount given by X bank to be disbursed only in a particular state, maybe AP or Telangana or Tamil Nadu or Uttar Pradesh, and where those cash flows can be captured through the bank account, whatever recoveries comes from those areas to be capped to the bank account, that can be monitored. Cash flow visibility can be monitored. Suppose any MFI expresses difficulty in segregating the area wise to the banker, it can be on a pari passu basis, but at least some pockets of the cash flows should be routed through a bank, which should be sufficient enough to service their debt. So the cash flow visibility the only way you can monitor the your funds, loan funds. I hope I am clear.
Sure, sir. Thank you so much, sir. The second question is, nobody in MFI business want to maintain growth and risk. They want growth. Their only solution at risk, only solution to risk is enough liquidity or does diversify balance sheet into risky products to save them from bankruptcy. This seems to be a comment. So, do you have a view on this?
Yeah. See, yeah, I rightly said risk a return. Higher risk, higher return. Growth and risk. Higher growth, higher risk. It You cannot have a situation where I will achieve a higher growth with low risk. Then you have to give only such kind of loans where the risk is very minimal. When you are selecting such kind of segment, you will not achieve the growth. So only thing is one should balance between growth and the risk. At the same time, you can grow. Well, can you change the overall landscape? For example, like right now we are giving 80% of your portfolio unsecured, 20% secured. Can you change the percentage to 70-30 or 60-40? As long as you are able to give loan to a gainful income generating activity, delinquencies will be less. Wherever your loans are for consumption loans or to repay the other loans, it will have its own impact. Only thing is, my suggestion to all MFI, please take the data. RBI also made a mandate that you cannot take from more than 3 lenders. They can, depending on the credit bureau reports, how much of debt is already outstanding, how many MFIs have already taken the loan. That can give you some kind of a transparency and restrictions, so that you can, over a period of time, you can improve the loan book size along with reduce the risk over a period of time. However, in case there is a risk sinks and all, the promoter should be able to raise the money capital and to see that losses are wiped off over a period of time. Once book stabilizes, once the good quality book improves over a period of time, automatically profits will get generated, company will grow. This is all from my side.
Thank you, sir. There's one more question which we received during registration. How do you decrease credit risk as there is no underwriting practice in MFI and all the repayment capacity totally depends on profitability of things sold? So there's no tracking of multiple loans to one person. So
Yeah. So this is what I told you already. It should be a self-regulated entity. See, all the MFA should come to a platform and draw a line how I should go. It cannot be that I will by stiff competition I will grow more, I will lend more, and do this kind of unethical practices. If we can be stopped by all the MFI as a group, definitely things will stabilize. That's what my view. And giving only for example, most of these loans are given to a hawkers, street vendors, hawkers and all. Their income sources are very very limited. Taking into account their family commitments and all, the leftover surplus will be very very marginal. Unless you have the focus, your focus should be geographical, where the particular area repayments are good, where particular area there is repayment stress. You have to divert your resources and technology towards these areas to see optimize your loan book vis-a-vis your delinquencies. This is how, otherwise it is very difficult to monitor such a voluminous of data manually and to see that recovery rates improves and book stabilizes. It is through either using artificial intelligence or machine learning models. There are many other latest technological advancements are coming up, and also your improve your quality of business rule engine. That's what it is. Yeah.
Sure, sir.
Next, you can take from the charts. I think presentation you can stop. I can charts. I will see one by one questions. I will just see.
Sure, sir.
Here, Nagaraj, after the registration was brought in by restricting the lenders to three, will it allow the reckless borrowers who are accustomed to more lending institutions start approaching the money lenders will be active? Vyamant, you would like to take this question?
Yeah, thank you, sir. Thank you. Well, the regulator has been keeping an eye on the industry over the period. The stricter norms that are coming are not a effect of one overnight or something. These are the process that they have been seeing. The processes were laid down from 22 onwards, and now they have become stricter when the practices have not arrested by themselves over the period. Your question lies in whether this kind of entity activities or restrictions will lead to more accustoming to money lenders. Now, the role of the regulator has been to have a stable financial system and also to encourage or literate the financial borrowers to not to over borrow themselves with the burden of the over borrowing. This is where the main purpose of the regulator as well as for the borrower would be the financial literacy and the collaborative approach, as we have already spoken about, that will help in achieving these goals and reduce dependency of these borrowers on the other segments. This will only benefit to the end use of the borrowers in the longer term, and also to have a more stable systems in the place.
Yeah. So next question, Vikrant. Uh, uh, shall I take it? Yeah.
Yes, sure, sir.
Yeah, I think Mr. Praveen Thakur has given not necessary. Nowadays, they can take personal loan from fintech like Navi. Yeah, yeah, this all when the restriction of three microfinance lenders, MFIs lenders only restricted, they got other fintech companies are there ready to give loans. This is very difficult to control. I do agree with the observation of Mr. Praveen Thakur. The, yeah, they're coming to Mr. Peter Ian. Every time when crisis happens, one of the rating agencies coming out showing this scenario. See, as a rating agency, we keep our eyes and ears open. We'll see what is happening in the market. What is happening? It is only to bring to the public at large or the industry at large to know what is happening in the industry, what are the corrective steps that can be taken, how regulator is looking at the portfolio. This is the job of a rating agency. Over and above what we do rating of the borrowers, we do a lot of research papers, we'll present research papers, we'll do conduct seminars so that people will be aware of it. That's how it is. Now coming to Mr. Praveen Thakur, and restricting the lenders to three will not work. Nobody can bind someone hand to take loan. MFN should have instructed MFA institution don't give loan to borrower taking loan more than one specific number of lender, either individual jointly. This is fine, but let us. I think MFN has come out with certain understanding. Maybe after implementation, maybe for a period of 3 to 6 months time, they can get some more feedback, and they can always change their strategy how it can be changed instead of restrict number of lenders, like amount can be restricted, all those things. There are a lot of things can change, but to start with there should be some system whereby some discipline can be brought in the environment. I think probably it is a first step towards that direction by MFIN. We are only hoping that the situation can be reviewed over a period of 3 to 6 months time and take further decisions by MFIN, which can be acceptable to all the MFIs. Next, Mr. Peter Ian. But rating tool has not been modified based on unsecured loan borrowers and MFI. In such stage, what will rating agency and help the sector? It is not that. Please understand the rating have a different models, we have a different workplace. Many factors we factor in the rating. It is not that secure. Actually, the importance given to security is almost zero in respect of rating agency. Well, awarding the rating, they look at various other risks like industry risk, business risk, finance risk, management risk, and other antecedental regulatory risks. We look at it. Security is only a very small component which may not make any difference with respect to the this one. Most of these unsecured loans are cash flow based repayments capacities based on which rating models are developed, and rating models are being back tested every year, and where suitable changes required as per the changing landscape being done by rating agencies. I'm very sure. Of course, at Brickwork, we do backtest all our models and make suitable changes as per the change in landscape in the industry. Next question, can you take Mr. Hemant? Prasul Biras?
There are new players entering this market. What is the thing that is attracting them to this market, and what major precautions should be taken when financing these new players? Very good question, Prajwal. Prajwal, as sir has already stated, that financial inclusion has still not reached to its peak. There is ample scope for many players, many board, many to reach out to them, and hence the new market, new players are entering into this. Obviously, this is a segment where people are encouraged to tap this market and grow further. Financial inclusion being the main role of this regulator, you have to reach this, and as many players with their capital support and their digital technology tools available with them, they can reach out to these. Now, what are the precautions that should be taken when financing these new players? Obviously, it is as good as you lend to a new borrower in any other segment. Those basic norms will always be applicable to these also. This is none other than other segment. But to understand that the role of these players is to reach to the segment or the strata of the society which is underserved, and whether those objectives are met by this organization. That is your credit call, which you have to understand and take at the time of lending these kind of active entities. Of course, you need to understand the promoter support and the management that is going to manage this show on an ongoing basis. Hope I've clarified your query.
Yeah. Next question is from Praveen Thakur. Exactly, not a question, is observation. I will read. There are two questions from Mr. Praveen Thakur. RBI removed the cap of interest increase maximum loan size of 2 lakhs, but same time want to restrict growth is not more than irony. And I don't agree that loan ticket size has been improved because of good borrower, but I think it because of high rural inflation, and loan disbursement has been reduced not just because of stress in MFI sector, but also entry of new players in this market, which are very aggressive in their lending practices. I do agree. See, some point of time, regulator has to bring certain restrictions. Otherwise, this portfolio once bulges up from the present level of 3.5 lakh crores to, let us say, 6 lakh crores or 10 lakh crores size, it will be very difficult to control at that point of time. Probably, regulator thought it fit to bring certain amount of discipline at this point of time. Probably the regulator may review the situation over a period of time to change whether 2 lakhs amount is to be increased or decreased, or number of land. All any changes can be done. But to start with, to begin with, to bring some streamlining in the industry, regulator has brought certain restrictions. Yes, and coming to, okay, some aggressive players are increased because of that. Some MFI's loan book size matter shrink. But overall, if you see, there is a shrink of almost 24, 25. Provisional numbers are out in the market. There is a degrowth of 14% in YOY. That itself shows overall industry's landscape. There is, because the funds available with MFI has come down because banks started lending at a lower pace to the MFIs because of the ability to lend aggressively has come down. So overall, MFI loan book has shrunk in the industry for financial 24-25. We expect that, okay, high rated borrower MFIs with a good business rule engine can aggressively go to the market and go for a good loan book. That may improve over a period of time. Next, Mr. Ganesh Adiga. Credit remains a top challenge for micro industries, especially in rural and semi-urban areas. Many enterprises still lack access to digitization, or individuals are simply not aware of how be effective use digital tools. So yes, this I agree. There is a large scope, as I already told in the conclusion remarks. There is a huge scope for growth in MSME segment. Many MSME, small medium players don't have access to the bank formal banking system. They're depending on outside market. But there is an improvement. The MSME department has come out with various schemes and all. They are marketing it through their development institutes across the globe, across the country. And we expect that the growth will happen for a period of time in MSME segment, and definitely access will be there banking sector to all the sectors. This what definitely the digitization has improved a lot. Digital lending practices, almost all the banks up to some 5 crores of loan, they are done end-to-end digital solution. Simply they go with the PAN card, Aadhaar card, and give you for company SIN number or whatever number. Automatically everything is checked back end through the respective websites and see the eligibility, and they're able to give a solution within 24 hours. They're able to give a sanction letter and also disbursement. So speed, accuracy, and quality is going up by virtue of the digital lending practices, which expect the portfolio to grow over a period of time. Yeah. Hemant, can you take Vishal Pujari any question?
Since most of he has just made a statement, that's correct.
What?
Since most of the loans of MFIs are unsecured, any credit score model mitigate can any credit score mitigate the lending risk, as there is no security for recovery, though the credit score model has its own advantages. So the credit score models are defined depending upon the industry. We know this industry is an unsecured loan industry, but the focus of this industry is completely different, like in case of any other personal loan or consumer loan segment. And that is duly captured in your model definitions where it is. Therefore, the credit score model for this will give you the correct output on a larger scale basis. Next question.
I think Vikrant's questions are over almost. Yeah, that is over already. I think
One
already
more
we time is also, we
second.
are just past 6 minutes past 1 hour. I think you
Yeah.
can give conclusion from Vikrant.
Sure. So I would like to thank you all for joining the webinar today, and we look forward to seeing you in our future events. Thank you so much.
Thank you.
Thank you.
Thank you, one and all.
Thank you all. Thank you all.